Hey, good afternoon, everyone. How's everybody? It's uh, uh, Thursday. Good afternoon, Zaniab. Happy Thursday, everyone. All righty. So let me just get a couple of things taken care of before. Okay, I'm gonna have to. Okay, I have to make myself a moderator. And all right. So I'm gonna share my screen. What's the difference between sharing and oh, all right. All right. So we are now moving on to uh, the video number 6, right? Because yesterday, topic 2, right? Uh, we wrapped up. Uh, we're wrapped up here at with uh, number financial statements intro number 5. So we're starting with intro 6. So it's going to be about the balance sheet, right? From actually, we got started on the balance sheet. Um, Once again, I would like to emphasize, one more time. It's very important to make the distinction here because the goal of these two statements are quite different. They are not about how profitable the company is, that which is the actually the goal of the um, income statement, because it's about profit. It's about profit, right? However, balance sheet, the goal of the balance sheet is the description of the capital structure. So the line items, therefore, the line items are different, and you should be able to tell apart between the two. For example, if it is operating income, it doesn't belong to the balance sheet. It is the income statement line item. And um, if it is, uh, if it is, something like, inventory, right? It's not income statement line item, but it is balance sheet line item. And although there are some overlaps, for example, depreciation appears in both statements, but most other line items are totally different. So that's something you have to pay attention to. Now let's take a listen to the video number 6. Okay.
Um, we we stopped right before defining the assets, because assets are used very. It's a term that is used very broadly, but to make clear distinction, right? We will need we need to make a clear definition of assets. Uh, Assets can be defined at least on 3 levels, just like liquidity being defined on 3 levels. First, in accounting class, if you've ever taken accounting, assets are defined as what you own, right? Assets are defined as what you own. And then liabilities are defined as what you owe. Now, but I always find this definition a little lacking because it's incomplete. Why? It's missing the definition of equity. Obviously, it makes sense. Uh, assets are what you own, uh, and some of the assets came from liabilities, right? Which is what you owe. But what about equity? Is equity what you owe? no, equity is not what you owe, but it is what you own, right? Now, of course, there's another explanation for that. I mean, the question is, if equity is not what you owe, why is it put on the same side as liability? Well, it's not. So the conclusion is, it's not actually what you own versus what you owe, right? It's actually, it's actually the distinction between where the capital came from and how it is held, right? So think about it. The company's total assets is 10 billion, right? Roughly 10 billion, right? And 60% of it came from debt and 40% came from equity. So that's the definition of capital structure. So basically, this $10 billion, right? Capital of $10 billion that was raised through debt and equity, right? Are held in the form of physical assets, right? Plant and equipment, land and building, and also in the form of current assets, right? Now, so the definition of what you own versus what you owe is not complete. And besides, if you explain what you own versus what you owe, equity is what you own, but it is still on the liability side. It's because that's where the capital came from.
Okay, let me pause it here for a while, and it looks like it's being recorded. Okay.
To be put into these assets. Another explanation for equity for being on the liability side is that equity is what the company owes to the owners. Okay. Well, if you look at it that way, right? If you separate the company from the ownership as a third party entity, as if it is a third party entity, then that explanation fits well. But again, yes, and it's quite a good explanation, because I've been telling you, ownership, right? Owners are not necessarily the company. Owners own the company, but the company is like a vessel, right? Company is like a vessel. So owners and the company is a vessel and a mechanism, but company is an inanimate object, inanimate entity anyway. So company doesn't retain. I mean, a company doesn't get the final ownership or claim on the profit, because profit is claimed by eventually by the owners. But the company, since a vessel and a mechanism to maximize its machine, right? Company is a vessel and a machine to.
Okay, I've been comparing the company to a vessel, but I guess better comparison would be like a vehicle. I mean, vehicle. It's a vehicle for channeling the profit to the owners, right? A vessel or vehicle, I guess, it doesn't make any difference whether you call it a vehicle or vessel, but sometimes vehicle may sound like a better description. Okay, let's continue.
To maximize the profit for shareholders. In that sense, right? In that sense, you can separate the owners. You will need to separate owners from the company, and also it's also the characteristics of the modern corporation, right? That the ownership and management are separate. You understand? Owners are not necessarily the management. Owners don't have to be the management. Owners own the company through stocks, through equity. The company is run by the management. Management is actually hired by the ownership. And if the management is doing a good job, the owners will keep the management, paying very high salary, outrageous salary, and keep the managers. But if the managers fail to live up to the goal, owners set target, then they can be fired, and new search for new management will begin. I mean, of course, they will search for the new management first, and then fire the old management later after the search process is over. So in that sense, yes, equity is what the company owes to the owner, to the owners, and but I would, if you define assets and liabilities, I mean, if you define it in terms of own and owe, right? I would say equity is what you, and when I say you, it's the owner, right? Owners own free of it, right? Now that's the first level of definition of assets, what you own and versus what you owe. On the second level, as we look at the balance sheet, it's already the definition of assets. Total assets are equal to total liabilities plus equity. In other words, this is called accounting equation. Assets are liabilities plus equity. I will just, because writing, liability takes time, I'll just call that the total debt plus equity, right? Debt plus equity. This is called accounting equation. So that means that's also why it is called balance sheet, meaning both sides must balance out. There must be the equal sign must hold, right? So that's basically the structure of balance sheet. On the third level, this is pretty much I would say very important concept of assets. Assets must generate income. Assets must have power to generate income, right? Assets must have income generating capabilities. Okay, understand? If assets have no income generating capability, they have no reason for being. They have no reason to be, and their value. I mean, although this is called book value. Basically, book value is the value recorded in the financial statement, in the balance sheet. Now, think about it. Book value starts with the purchase cost. I mean, plant and equipment. This $6 billion is the purchase cost of plant and equipment. If you are at time zero at the beginning, and each year, right, this book value will go down because why? Because of depreciation. In other words, what's depreciation? It's the I mean, literally, it's the decrease in the value of the asset. But then the value of the asset naturally decreases because as you use those assets, due to wear and tear, right? It's aging simply, right? As you use the assets, it wears and tears, so the value goes down. I mean, it's not just the because it's not just you might say obviously, when you will say the value will with aging everything, the value of everything goes down. Yeah, true, but think about a building, right? Value if you are not doing any maintenance, right? The building will clearly go down in value because of dilapidation, right? But think about the production equipment. Think about the plant. It's not only because of aging. I mean, with the aging, with wear and tear, what goes down too? The production capacity goes down too, isn't it right? As the production equipment, right, plant and equipment ages, the wear and tear brings down the production productivity and the production capacity, right? Yeah. A very simple example. I don't need to even bring up a simple example, but everything when it is new are at its maximum production capacity, highest production capacity. I mean, suppose you bought an air conditioner, right? But at the beginning, at time zero, right, in the first year, what do you notice? You notice nothing. I mean, the only thing you notice is the temperature, room temperature, has drastically gone down, right? In a matter of seconds. But you don't notice, you don't hear anything. I mean, no noise, very quiet, cools the room very quickly. But as time goes on, what is it? Second year, third year, fourth year, it takes more time to cool the room to the same temperature, right? It takes more time. And that means it's not getting that cool very soon. It's still very warm. And besides, you hear a lot of noise, right? At time zero, it was very quiet. Now it's a clunker. It makes a lot of clunking noise, right? A lot of noise. So what does that mean? The productivity has gone down. Why? Due to wear and tear. Make sense? That's depreciation. At time zero, plant and equipment may have been 6 million. Building may have been something. Land doesn't depreciate, right? Land doesn't depreciate. But by the way, but here depreciation is defined this way, but actually depreciation has more tax implication. I mean, there's a huge thing that the depreciation does in terms of tax savings, reducing taxes. Okay, so we'll talk about that later. But when assets are defined as something that has income generating power, that income generating power will gradually go down if you don't do anything about it. Of course, nobody will just, no management will just, watch it just hands down, right? Because if due to depreciation, if the production capacity goes down, that means their output goes down. As output goes down, the revenue will go down, right? So, and as the revenue goes down, and output and revenue goes down, the market share of this company goes down, and no management will just watch it hands down. So, what do? They replace the worn-out portion of the capital, or even expand, right? To maintain a constant production capacity, or even expand the production capacity, right? Now, assets. So that's the book value of the asset, and the market value of the assets. A market value is a different thing, right? Market value would, by definition, it is determined by demand and supply. So the market value may be will be a different thing from the book value. Now, our question is now, I need to. So when we, there will be a further discussion about the, the specific line items of current assets and specific line items of the current liabilities later in another video. But I want to wrap up, because the whole point is, how does this have to do? How does it tie together with return on investment? At the beginning of the this lecture series, I said ROI on micro in micro context. In other words, from firm's perspective, are defined as return on assets and return on equity. So think about it. If you are an investor, right, you would want to know. Suppose you are considering to buy stocks in this company, and you would want to know how much is the on average, how much return you get on equity in general. So the formula for return on equity is, what is return? I've been telling you, a profit is the return, right? And if you divide profit by equity, right? Of course, that's return on equity, right? And of course, the higher the number, the better it is. Because equity is the input, profit is the output. For example, this company's equity is 40 billion, right? 4 billion, right? And suppose this company's profit was 1 billion. I don't know if that was when I was there, but if this is the case, what is the return on equity? It's 25%, right? 1/4, 25%. This is pretty good, right? Compared to average return on equity. Now, in other words, it is output to input ratio, and I've been telling you, the output to input ratio is a very solid and fundamental measure of efficiency, right? Productivity is a kind of efficiency, right? And obviously, for minimum input, if you get the maximum output, that would be wonderful. Or some to put maximum output and get maximum input and get minimum output. And obviously, that is you don't want that. You want to avoid such an investment opportunity. Now, what is return on assets? It's also a profit over, now this time, total assets. Why? Total assets is also input. Think about it. Plant and equipment. That $10 billion capital is asset, total asset. And what is asset? Assets are the machines to generate income, right? Assets exist. The sole purpose of asset, right, is to generate income. And so it's like, it has to be lean and mean. If you weigh 200 pounds and if you're all bone and muscles, then there's a lot of, you can lift a lot of weight. Compared to the same 200 pounds, but full of just fat. No muscle, no bone, just fat. What can you lift, right? 200 pounds of just pure fat can lift no weight, right? In other words, there will be no output. In other words, you want it to be lean and mean. you want it to be just lean and mean, pure muscle and bones, and then the efficiency or the productivity of that 200-pound structure would be very high. And as an investor, you want to invest in such 200 pounds rather than 200 pounds of fat that has no zero productivity, right? So if you measure that in our example, our total assets was 10 billion, right? So it's 1 billion over 10 billion, right? It's going to be 10%. Now, we can also notice one thing. Mathematically, between ROA and ROE, which one is mathematically bound to be greater? Of course, ROE is bound to be greater. Why? Because of the different denominator, right? Basically, the numerator is the same, and then if the numerator is the same, whichever one has a smaller denominator will end up greater fraction. Makes sense? And since equity, if you're looking at the same company and measure its ROA and ROE, return on asset, return on equity, because equity is one part of total assets, right? The other one is debt. This ratio will always come out greater. Makes sense? But then think about it. Return on equity is the most relevant number for the equity holders or stockholders, right? Or shareholders, right? But since profit doesn't go to the bondholders, this number is actually not useful for bondholders. For bond or debt holders or bondholders or creditors, right? For creditors, ROA is more relevant number, right? But then again, you might say it's unfair. I mean, because this is more relevant to the debt holders because total assets include debt, right? Total assets is debt plus equity, and it is still a not a very fair measure. Why? Anyway, profit is still not. It doesn't relate to. It's not relevant to the debt holders because this belongs to only the equity holders. So actually, there is a variant of ROA for debt holders, right? Because from the debt holders' perspective, using net profit is not a fair measure. So they use. So for the creditors or bondholders or debt holders, EBIT, the operating profit, is a better measure of profit, the operating profit. Why? Because in EBIT, the interest payment to the debt holders are included. So sometimes ROA is measured this way. If you measure it this way, then there's no guarantee that this will always be greater than ROE. Okay, makes sense? All right. So that's it for this segment of the video.
All right. So we're moving on to video 7, number 7. But before we do that, any questions so far? Any questions? Any questions?
Yes, Professor. What does EBIT stand for? I didn't hear that.
You didn't hear what?
EBIT. What does that stand for?
Oh, EBIT.
Yeah.
Earnings
what does it stand for?
Earnings before interest and taxes.
Say that one more time. Earning before taxes. Is that?
Earnings before interest and taxes.
Okay.
Let me bring it. Look, it's also called operating income, but earnings before interest and taxes is quite self-explanatory, right? It's self-explanatory.
It's gross income, right?
Interest and taxes. So before interest, right? Before taxes, right? So literally it's self-explanatory, right? It literally means it's the earning or profit before paying before paying interest and taxes. Okay, that makes
Is
sense?
that gross income? Is it gross income? Is it same as gross
No,
income?
no, 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 no.
No?
Gross income. There's gross income is this is gross income.
Oh, yeah,
Think about
before
it.
expenses. That's right. Gross income
Yeah,
is
yeah.
before expenses. Got
And
it.
once you subtract, once you take out returns and allowances, then it's called net revenue, right? Uh, Not net profit. Net profit is this. This is net profit, okay? And also, if you, okay, uh, and another thing is there is something called gross profit. Again, gross profit over and over, I say that is not really true measure of profit because if you subtract only CGS, this is CGS, right? And from this, you subtract this. So that's before subtracting operating expenses. These are operating expenses, right? So if you subtract
Okay.
only this, then that's called gross profit. Okay? Subtracting only CGS, that's called gross profit. So gross profit or gross margin. So when you have to be very clear about these names because you think this is gross income. No, that's not gross income, right? And that's the reason I don't like repeating the word income over and over because that it can be very confusing. Okay. All righty. Any further questions? Any other questions? I think that's my voice being echoed in your microphone, and so. All right. So if there are no further questions, let's continue with the 7.
This would be video number 7. So it's been longer than I hoped it to be. But that's the nature of this. That's the nature of this discipline, this field. I mean, uh, you can just skim the surface, but have gain no insight, or you may struggle to go deep into the and take time, a lot of time to break it down and go deep and uh, gain a solid systemic understanding and insight about it. So, um, and I'm always pursuing the letter, so it's inevitable. If it takes that much time, we'll have to. So be it. Now, so in our last lecture, we discussed how ROA and ROE can be measured, but then we also came up with some concepts like book value. Now let's think about it. So suppose we are, so let's say we are, uh, and we are calculating the book value, right? Try. Can I try? Let's try this. So ROE, return equity, is then calculated as profit over equity. But then here's the thing. Now let's think about it. profit is also called EAT. Net profit is called EAT. So let me change that to. Okay, never mind. I'll just write it like this. EAT over equity. Now, here's the thing. We must consider the time dimension. I mean, we cannot ignore the time dimension. In other words, what I'm saying is, ROE, return on equity, is measured as of when? Now let's think about it. As of when? It can be measured at the end of the year, isn't it right? Because you want to know, I mean, if we are at time 0, which is the beginning of this year, as well as the end of the last year, right? And then ROE at time 1, I mean, we will measure, when do we measure profit? The profit will be measured, first year profit will be measured at the end of the first year. In other words, this EAT is the EAT at the end of year 1. Right? Isn't it right? Yes. And so that means our return on equity is actually return on equity at time 1. Right? Now, and the equity, let's think about equity. Basically, this profit is the result of the workings of the equity. I mean, the reason we are measuring ROE is to just the same rationale, same reasoning as we measure the gas mileage, right? In other words, profit is the result of the workings of equity. So that's profit is the output, equity is the input. Makes sense? Now, and this profit is the result of workings of equity as of when? The equity, this is the equity at time 0, if you think about it, isn't it right? In other words, profit is measured at the result of workings of equity that was in place at time 0, and that equity worked hard for 1 year and produced this result. So this is the fruit of the EAT at time 1 is the fruit of the workings of the equity at time 0. Make sense? So that so if we think about this time dimension, we can easily you can understand that we need we need, first of all, of course, income statement and balance sheet. But then we need the balance sheet at 2 points in time. I don't know what's happening here. It's actually equity at we need balance sheet at time 0, and we need balance sheet at time 1, right? What you're seeing here is only balance sheet at time 0, right? But think about it. 1 year later, balance sheet is like a snapshot, right? So it's a static states, right? A snapshot picture. So we have all the total assets listed in the values in the book. That's called book value, right? Because it's recorded at time 0, recorded at time 0, right? All the liabilities and equity also recorded as of time 0. And then 1 year later, at the end of that year, then all of these will have changed, right? So we will need a balance sheet at time 1 as well. And also the reason for the change is due to the operating activity, and the operating activity is recorded in income statement, and this net income, net profit, or EAT, is recorded at the end of the year. It's the result. Think about it. You cannot have fruit at the beginning of the year, right? The harvest will come at the end of the year. So this net profit is as of the end of the year. And if you think about it, at least you can tell that the equity will have changed from time 0 and time 1. In other words, equity at time 1 will be greater than equity at time 0. Of course, it can be less, because if the company has made done a good job and made a lot of profit, right? at least the equity will value will increase by as much as the profit. In other words, equity at time 1 is the result of equity at time 0 and EAT at time 1. Understand? Surely, in terms of book value, why? Is EAT equity? Then the next question is net profit, is it? Yes, it's equity. Think about it. In terms of nature of capital, I mean, EAT is profit, and where does the profit belong to? I mean, is it equity or is it debt? It's clear, it's equity without question. Why? Because who does this belong to? Who does the profit belong to? Profit belongs to the owners, isn't that right? If profit belongs to the owners, then in terms of nature of capital, right? There are only two types of capital, equity or debt. In terms of nature of capital, what is it? It is equity, because it's owner's capital, isn't it right? So in other words, EAT is a equity generated by operating activity, right? Equity generated by operating activity for 1 year. Right? That makes sense. It's generated by, because there are two types of capital, two types of equity. I mean, of course, you say two types of capital. Oh, debt and equity. Yeah, but also in the sense, in terms of where that capital came from. In other words, original equity at time 0 is the capital. Is called capital paid in by the investors. Make sense? Equity at time 0 is paid in capital. It's paid in capital, right? You see what that means? Paid in capital. They it came from the investors. Whereas this is an equity that is generated by the firm, by its own operating activity, right? The firm generated this equity, but it belongs to the owners, because think about it. If you have an orchard and you have apple trees, right? Apple trees are like your equity at time 0, right? And the EAT is the fruit, the apples, the fruit of the tree. And then, of course, apple is not the tree, but when you sell those apples, right, you can buy new trees, right? In other words, then if previously you had 100 apple trees in your orchard, but with additional with the profit, in other words, with the apples, you sold those apples, and the apples were worth 10% of the original value of the trees. Then you can buy 10% more trees, right? And then you have 110 trees, apple trees, which will increase the productivity, and which will increase the production level by 10%. Output capacity increased by 10%. Right? That makes sense. So that's the connection, right? Now, then our next question is, if the share price, what is the share price? Share price is stock price. There are two types of prices: market price and book value. And once again, market price is determined by demand and supply, but book value is, first of all, book value, that means, and then PS, per share. Book value per share. Why? Now, suppose the equity was, $4 billion. I mean, this company had $4 billion of equity at time 0, right? So then, book value per share at time 0 is equity, book value of equity at time 0 divided by number of shares. Isn't that right? Because that's the definition of what per share means. Number of shares outstanding. I'm not going to write outstanding. Outstanding means held by investors. And because some stocks can be repurchased by the company with the purpose of artificially raising stock price. But anyway, that's by definition book value per share. Okay. Then we understand that the EAT is profit, but net profit, but it is it's an aggregate concept, right? In other words, profit we are talking about is the total profit for the company, but for individual shareholders, what is the portion of that profit. Of course, for me, I mean, for individual investors, if I'm holding 10 shares of this company, right, my share in that profit can be calculated by profit per share, which is simply dividing the profit by number of shares, right? And then the profit per share times 10 shares that I have. So actually, profit per share there's another name. It's called earnings per share. Okay, but what is earnings per share at which time point? Which point in time? Of course, we have earnings at earnings after taxes at time 1. So our earnings per share is at time 1, right? That's earnings per share at time 1, which is simply EAT at time 1 divided by number of shares. Make sense? Then now think about it. Then we can, what's going to be then book value per share at time 1? Well, then book value per share at time 1, I say, oh, then that must be isn't it simply equity at time 1? Isn't it simply equity at time 1, right, divided by number of shares? Yes, that's true. But also, we can rewrite it as book value per let me do it this way. But then by definition, right, what is equity at time 1? Is equity at time 0 plus EAT, earnings after taxes at time 1, divided by number of shares, right? But then we can break it up, right? In other words, what is then equity at time 0 divided by number of shares? It's exactly book value per share at time 0. And then what is EAT? 1. What is that? What is EAT over 1? EAT at time 1 over number of shares. That's earnings per share at time 1, right? In other words, it's exactly reflecting, right? What is earnings per share? It's profit per share. So in other words, book value at time 1 will reflect exactly the profit, right? And that's why I said, when you sell, I mean, if you want to cash out your profit, then all you need to do is sell your stocks, because your stocks will reflect. I mean, if you are holding, if you bought that stock at time 0, and 1 year later at time 1 you want to sell it, then whatever you paid at the time, the stock price at time 1 will exactly be greater than book value per share at time 0 by earnings per share, right? In other words, it will reflect, the stock price will reflect exactly the profit, right? In other words, the increased value due to operating activity. Now, again, what I'm saying is, this is the book value. Market value will deviate from this. Market value will deviate from this because market value is not exactly the same thing as the book value, because market value is the result of demand and supply. But this mechanism explains very succinctly how these concepts are related. Okay, so that wraps up our discussion about the intro to financial statements. Again, this is the 7th video, and we will stop here for this topic, right? There are other videos, 1-hour-long videos, labeled, financial statements 1, part 1, part 2, part 3. We don't have time for all that. I mean, since this is pre-recorded video, if you're interested, you can view them outside, scheduled class time. But for the purpose of our class, this will be the last video. And of course, it's important to at least go into financial statements part 1 video, because there's further explanation. There's further explanation to the minor line items in current assets and current liabilities. Actually, if you can watch, financial statements part 1 and 2, that would be great, right?
All right. So we're not, as I said, we're not gonna go into financial statements part 1 and 2, but we're gonna. I strongly recommend you. We're gonna look into these factoring. What factoring means, right? Okay. So, any questions so far? Any questions? Any questions? Any questions? Okay, I'll take it as no. And then, but just to make sure, we're going to go into factoring, because factoring is quite important to understand how promissory notes work. So let's go into
Hi, welcome back to the topic today is simple discount. Now, to understand what a simple discount is, we need to introduce a new terminology called, promissory note. Now,
okay, so before we go any further, let me let's go into the breakdown of the balance sheet, right? In the balance sheet, right, there's cash and cash equivalents and marketable securities. Marketable securities are basically stocks and bonds. And cash equivalents are very liquid. Cash equivalents are very liquid short-term debt instruments. Highly liquid. Liquid. Short-term. Now, short-term instruments could be, could have, even, 10-day or 3-day, very short-term, commercial papers, and promissory notes are also short-term debts, right? Now, the term promissory notes, from the name, you can tell, oh, it's something like a promise to pay. Shouldn't it be like something like that? Yes, it's an IOU. However, personal IOU, it's generally not traded, because a personal IOU is something that you write when you usually, when you buy a house, as part of the contract, you have to write, and write up. It's a pre-formatted form. I mean, the lawyers will give you the form, and you just sign it. However, the thing is, it goes no further. It just stops there. I mean, if you don't, if you can't come up with the money to pay for the house, right? And that is, after making a deposit or down payment. I'm sorry, after making the down payment, the balance will have to be financed. So you get the loan from the bank, but if you fail to get the loan from the bank, this deal is off. This deal is off, isn't it right? Promissory note doesn't do anything, right? Uh, so it cannot get traded. It cannot be like an other debt instrument or stock that are traded in the market. However, promissory notes can be traded. It's someone's, not someone's, but some companies. Some companies promise to pay. So, in other words, it's a credit purchase from the buyer's perspective, and from the seller's perspective, it's a credit sale. The buyer writes a promissory note to pay, without using cash or without using credit card. Think about it. If you use credit card, it buys you only 1 month's time, isn't that right? But if you use promissory note, it's like getting a credit sale, getting and with the maturity up to theoretically up to 270 days. But nobody, think about it. If the promissory note is maturity of the promissory note is 270 days, that's like I will pay you 270 days later. That is who's gonna accept such promissory notes? So that's just ridiculous. It just doesn't. Usually, the maximum length of the practical and realistic maximum length of the promissory note is about 60 days. So usually 30 days, 60 days, And the sellers try to collect within at least 45 days. That's the general practice. So then our next question is, if you are the seller and if you receive 60-day promissory note, do you have to wait 60 days for to collect this money? 60 days later, how you get paid is you present this promissory note to the issuer, right? And then they will pay you the promised, face value, the promised sum. Or to make this, obviously from the seller's perspective, this is not the preferred way of settlement, right? This is not the preferred way of settlement. However, as a seller, you are not always in the most favorable position. You may not be the one to call the shot, right? If you are in a seller's market, you call the shot. But if you're in the buyer's market, the sellers don't call the shot. So you have to, to make the sale. Otherwise, if they don't buy, you are losing business. So to make it easier, right, for yourself to make the sale, you accept promissory note. Sometimes, but also think about it. Buyers, from the seller's perspective, buyers are not all the same. There are excellent buyers. The buyers who are always good on their credit terms, and buyers who are very trustworthy, creditworthy, and very faithful. The buyers who are more likely to default. So obviously, then the buyers, if you're a good buyer, you always pay on time and everything. You don't have to offer any more incentives than just the promissory note. But sometimes some buyers will have to offer strong incentives to the sellers to accept their promissory note. So on the promissory note, they add some interest. Okay. So then the next question is then, will the promissory note, once again, do the sellers hold on to this promissory note until the maturity and collect it at the maturity date? No, they don't have to do it like that. Because if I can wait 60 days, fine. I mean, if my business has a great cash flow and I'm not, really strict of cash, right? I can wait. And then on day 60, I will receive both the face value plus interest, the maturity value. However, if I am a small business, and small business are usually stripped of cash, their cash flow situation is not that good. So small businesses do not hold on to the promissory note. Then what do? They take it to the bank. They take it to the bank or third-party finance firms, financial companies that are specializing in buying promissory notes. So in other words, you transfer this promissory note to the bank, and the bank will pay you a discounted amount of the face value. They're not going to give you the full value because think about it. Taking over this promissory note from you means also taking over the risk of not getting this money, just in case, right? So the bank will discount it and pay you something smaller, and then the bank holds on to it, right? And then they present it to the issuer of the promissory note on the maturity date, and then they collect the full face value, right? That's how it works. So we're going to look into that mechanism, how the promissory note works, okay?
Actually, the reason we have been talking about simple interest in the previous videos is actually to serve as the foundation for simple discount. Okay, because if you remember, right, I said simple interest rate is not used in the capital market. And what's a capital market? The capital market is a long-term financial market, right? So in the long-term financial market, I said it's compounded interest that is being used, not the simple interest, right? And the simple interest is reserved mainly for short-term financial market called money market. But in the examples, right, some maturities longer than 1 year has been used. I mean, of course, as a pedagogical example, it was inevitable to use longer maturities than 1 year. But I also gave you a caveat that that was only for practice purpose, right? And the reason that we had to use such examples for simple interest was all to basically train you to prepare you for to familiarize to familiarize you with the simple interest, the way the simple interest works, right? And the simple interest is more frequently used in the situation where they have to discount the promissory note. So what is the promissory note? First of all, a promissory note is a short-term debt, right? Short-term debt instrument. Of course, that means the maturity is under 1 year, and literally, promissory notes. It may not be difficult to understand what it means. It's a promise to pay. It's a note that promises to pay. So it sounds like It's an IOU. Sounds like, but actually it's not that simple. It's an IOU, that's true. But you might think, oh, I can write a promissory note. You can write an IOU, but then problem is, who honors your IOU?
Okay,
right?
I guess this part.
Can you walk into an absolutely not? Why? Guarantee, or it is my, bond, right? Is an IOU used by a very close circle, like family, meaning that they are willing to, of course, right? They won't even think about it. Is only the term, the distinction at this point. But then, why would companies issue promissory note? So, suppose you are a computer manufacturer like Dell, right? And then Dell makes computers, but that doesn't mean Dell makes everything, right? This is not, this is not even a secret, right? It's a public knowledge, right? Because parts and components, something like keyboard, right? Mouse, right? The LED display panel. All these things are made by third-party manufacturers, right? Dell just outsources these parts and components, and they assemble, right? These components. So only elementary school kids would think a manufacturer would make everything from the scratch, like a car company, Ford Motors, would make everything from tires, in bolts and nuts, everything. A grown-up wouldn't even that's too naive if a grown-up thinks that way. That Ford Motor Company makes even bolts and nuts and rubber, right? So think about it. A manufacturer like Dell would, and the memory chip that goes into the computer, Dell computer, is made by some third-party memory chip manufacturers like Intel or Samsung or Hynix, or right. Also. The hard drive is made by also other manufacturers like Toshiba or Seagate, or a lot of. So these parts and components are outsourced, right? And so suppose Dell is making Dell has a production plant for 10,000 units of Model X, right? And then they will need to outsource things like mouse, right? Let's say, or like touchpad, or keyboard. So let's say keyboard manufacturer, right? So they will have to order 10,000 keyboards from a keyboard manufacturer. And when Dell buys 10,000 keyboards, there are 4 payment options largely, right? Dell has 4 payment options. Of course, they can pay cash up front, right? Cash. If each keyboard is like $20, they can pay 20 times 10,000, so that's going to be like $200,000, right? They can pay cash up front, or they can pay with check, right? They can pay by check. Or 3, they can pay with credit card. 4, they can pay with promissory note. Now think about it. Which payment method would Dell prefer the most? If someone says, if any one of you say, cash, I'm sorry, you're very wrong, right? Well, cash would be preferred. Of course, if you pay cash, then the seller will be very happy. Right? From seller's perspective, receiving cash is the best thing, right? Why? I'm going to explain this to you right now. Actually, from the buyer's perspective, promissory note is the most preferred choice, right? And the second preferred choice is credit card. And the third preferred choice is check. And the least preferred choice is cash. Why? First of all, think of, why is cash the least preferred? It's called opportunity cost, right? It's called opportunity. Why? Suppose you pay out $200,000 in cash right now, right? What does that mean? They are losing the opportunities that they could have put that $200,000 into some lucrative investment opportunity and earn some return on it. For example, if they can defer payment for 2 months at least, defer payment for 2 months. In other words, deferred cash payment for 2 months. They can, in the meantime, they can put those $200,000 into some stock, some hot stock, like of course, stocks have huge, stocks come with huge risk. You may lose, everything. But let's say, fortunately, they put, they have very good timing, so they put it into a Tesla, and Tesla is, last year Tesla grew almost like, right before the COVID-19 outbreak. Tesla and the COVID-19 induced market crash. Tesla was from earlier last year, 2019, earlier 2019, Tesla was trading around $200, and right before COVID-19, they were trading at around $900. Now Tesla is
Okay, once again, please take it with some grain of salt. This video was made in 2020, so point of reference, right? Obviously, 2020 it's based on, right? Okay.
Around 1200, 1400, I guess. The latest I checked was like 1400. Of course, it depends on you. It will change by the time you watch this video. Then it will change. It will have changed. But let's say last year, Dell deferred this payment for 2 months, and then bought Tesla when it was like $200, and in 2 months it went up to $600. Let's say, right? That's over just 2 months. It made, right, from it made what from 200 to 600. That's a 300% return, right? I mean, just the net return alone is 200% net return, because the capital gains is $400. So the net return alone is 200%. Gross return is, of course, 300%. Now, gross return is not a pure return, right? Because it's already including the original price, right? But anyway, why would you forego such an opportunity? If you, of course, you have to take the risk. But if you made a entry at the right timing, and you made an exit at the right timing, in just two months, you would have realized like 400% return. So that's why they don't. That's called opportunity cost, because if you had paid cash, you would have lost that opportunity, right? So cash is the least preferred payment method from the seller's perspective, but from the buyer's perspective, it's the most preferred payment method for the same reason, because the buyer could have also put it into Tesla and made in 2 months, right, 200% net return. Now, so then let's think about it. If you paid with check, right? Check is because I explained what cash, why cash is least preferred. Now, so cash is least preferred by the buyer because it doesn't buy you any time, right? Now, if you paid with check, it buys you a little more time than.
Okay, so I guess since the time is 7:11 right now, I think it's a good time to take a 10-minute break and reconvene at 7:20, 20 or 21. Okay, so let's take a 10-minute break. 10-minute. Okay. Any questions? Any questions? All right. Let's take a 10-minute.
How much longer do we have of the break? Sorry?
Hello, Professor. Hello, Professor. Hello, Professor.
Yeah, who is that? Shanaz?
Yes, Professor. Hi.
Yeah,
Are we?
I stepped away because I stepped away from my desk
Oh, I'm
because
so
we're on
sorry.
a
We're
break.
on a break, right?
Yeah, we're on a break.
Until
So
what
if
time?
you have
7:20?
a question during the break, you have to
Sorry.
ask it
Yeah, I'll wait
verbally.
till the break is
Yeah,
over. No problem.
yeah, you can type in the chat box.
Okay, Professor. Thank you.
All righty. All right, we're back. We're back. So let's pick it up from where we left off.
Cash, but it's almost instantaneous. I mean, it's not just as instantaneous as cash, but suppose you pay with check. How long does it take to clear? Usually between 3 days to 1 week, right? Large amounts like $200,000 may take up to a week, 5 days to up to a week. But usually smaller amounts are usually cleared within a day or up to 3 days, right? So it doesn't buy you that much time because your bank account will go down within 3 days by $200,000. And then for the same reason or for similar reason, right? The next second preferred method. I mean, I started from the least preferred and third preferred, and then second preferred method is then, of course, credit card, because credit card buys you at least 1 month, isn't it right? You make the payment. The credit card company pays the seller, and then they will usually you will need they give you 1 month to make the payment, so it buys you time. Now, promissory note is then the most preferred payment method because it can buy you time. Just theoretically, up to like 270 days. Of course, theoretically, anything under 1 year is a theoretically possible maturity, but that doesn't mean in reality it is really feasible, because in reality, most commonly used maturity date for promissory note is like 60 days, right? It can go up to 90, 120, but then think about it. Who's going to accept promissory note that has maturity longer than 90 days or 60? First of all, if a company is not receiving payment cash, if the company doesn't have cash flow, right? Of course, promissory note is also part of cash flow, but you have to understand that it's not really cash, right? I mean, it's just liquid asset. Promissory note is just liquid asset. You can convert it into cash, but it's not directly cash. Now, what I'm trying to say is, promissory note most commonly, buys your time up to 60 days. That means, from the buyer's perspective, it's the most preferred. But that means from the seller's perspective, this is the least preferred. Why? Because you have to wait 60 days to receive cash, right? So promissory note is a part of the accounts payable from the buyer's perspective, and from the seller's perspective, it is part of the accounts receivable. But then here's the thing. You might wonder, so can the seller reject promissory note? I mean, can they insist on receiving cash? No, in reality, no. Why? No, it's like saying, suppose you go to you are a department store, or let's say you are a small store, and you insist on receiving only cash. We don't accept credit card. I know some restaurants, right, insist on receiving cash only. You can do that. You can afford to do that if your business is so booming. You cannot, the customers are lining up, around the corner, and the queue is going all, 7 blocks, you cannot accommodate all of them. And then you're in a position to, the demand is so huge, you're in a position to demand only cash payment, right? Some restaurants are like that, like, Cats, I don't know if they are in a position to do that anymore.
Okay. But I guess this part was already explained before the break, live, by me. So I would like you to listen to the rest of it, but you were supposed to have already watched this. So I guess just for the sake of our time, I think I can skip this part and actually get to the real exercise part. So let's skip. I don't know how.
Seller. I mean, L is a manufacturer, right? There are proprietary about the payment method. It's usually the promissory note. Actually, promissory note looks like a check, right? It's a commercial paper, so it looks like some kind of check. The only difference is that the promissory note has maturity, right? So that means this note becomes due in 60 days. They put the calendar date on it, and then also it carries interest,
Okay.
right? It's from the sellers, at the seller's end. Because if seller using that fund more than, I will have to stop the video.
I can skip the whole rest of it, and then let's go to part 2. I want to talk about the real.
Hi, Dr. Jeff Holm and account. And in our last video, promissory note deferred payment from the buyer to the seller is almost instantaneous. I mean, even if it is even if it is deferred, it's not it doesn't take more than a week for the check to clear. The large amount of checks just clear the check. But the reason is not because most of the times it's because they want to use their money, right? The balance sheet is recorded in the current asset side, and it is like a promissory note, and it is recorded in the current asset side, and it is like accounts receivable. It is considered a part of accounts receivable, and from the buyer's side, or the issuer, right? The issuer of the promissory note, right? From the standpoint of the issuer of the promissory note, that's part of it's notes payable, right? Basically, so it's part of the accounts payable. Okay. So, and I said also that the promissory note has carries interest rate and has maturity. Usually, anywhere between 30 to 60 days. I mean, more than 60 days. Maturity longer than 60 days are not. If the maturity on the promissory note principal, if you're holding on to the promissory note for 60 days, right, then you will receive. For example, it's like this. So you will receive, if Dell purchased $100,000 worth of parts and components from the manufacturer and issued the 60-day promissory notes at 10% interest rate. So obviously, the principal amount is 100K. And then with the interest, 10% interest, then you think, oh, so it's 110,000. No, we can assume, for simplicity, we can assume that way. But think about it. All the interest rates are annual, so 10K would be the interest if you hold it for 1 year. But the maturity on the promissory note is only 60 days, right? That R is APR, right? So to be exact, we already know time 60 days. Then what's the face value of the promissory maturity value? We call that maturity value now because at maturity, that's the same thing as future value. What's the maturity value? Maturity value will be then, we all know, principal times R times T, and this T is in years, right? So the maturity value will have to be 10K.
This one is only interest.
0.1.
Only interest, right? It's only interest.
And
I'm correcting it later. I'm correcting it in the video. I'm correcting it later. It's not mature.
10K, that's not minus. This is not easy to okay. Drawing with the mouse is not that easy, right? 10K times 1 plus 0.1 times, right? Uh, 60 over 360, which will be 1 over 6, right? Anyway, 60 over 360, right? Okay, that's the maturity value. If you hold on to it now until maturity. But let's just, for simplicity's sake, let's assume this is just, 110K. Now, if everything goes well and the recipient of the promissory note, or the seller, right, has no cash flow problem, if they have no cash flow problem, there's no problem. They can hold it until maturity, and at maturity they present it to the issuer, and they will collect 110K. But as I said, most small suppliers, right? I mean, for Dell, keyboard manufacturer is a supplier of parts and components, and it is also called vendor, right? So most vendors are
okay. So once again, their maturity value. This is correct. This is correct, right? But this is only the interest, right? Interest is principal times interest rate times time. So strictly speaking, you cannot put equal sign here. I mean, MV is equal to this, but I was, kind of, absent-minded at the time, and I was, carried away too far. And this is interesting, right? So please take it with some grain of salt.
Small businesses, smaller, relatively smaller companies, and they are constantly fraught with, they're constantly suffering from cash flow shortage, right? So they don't have the luxury of waiting until maturity. They don't have the luxury of holding on to it until maturity. So and so if they are hit by some, cash flow problem, what are they going to do? What are they supposed to do? Now, this is where, promissory note works, comes into play. The promissory note is part of the liquid assets or financial assets. In other words, it's a commercial paper that can be negotiated, negotiable with the bank, right? In other words, they can sell it to the bank. Okay. Now, promissory notes. Think about it. Cash is already cash, right? Cash equivalents are short-term securities that are easily converted into cash. It's called, liquid assets, and
Okay.
The prices do not in value as much as the stocks, fluctuate or easily converted into cash. And those assets are called current assets. They'll be also liquid assets.
Discussed.
So to present it to the, they are negotiable. Oh, 10K. It's not clearly 11K, right? But let's just assume that this is just for the simplicities, right? Say, let's just say 11K, just for the simplicity. Now, if you hold on to it to maturity, then you will get 11K, but you can't hold it until maturity, so you take it to the bank and sell it, right? And the bank won't pay them 11K, clearly, right? Think about it. No bank, so it has maturity of 60 days. Technically, they can sell it to the bank already on day one, right? Now, think about it. If they sell it on day one, will the bank give them 11K? Suppose bank paid 11K, bank gave 11K to this company, and bank is then, what's the bank to do? It's going to hold it until maturity and present it to the issuer, and they will collect 11K, right? But then bank is doing, I mean, if the bank gave out 11K to the company that brought the promissory note to the bank, if they gave out 11K, then the bank is doing this for nothing, isn't it right? Bank has to make something out of this. You understand? If seller sold, and it's called actually, factoring. If the seller factored it on day one, actually seller didn't take any risk to deserve that interest. You understand? If the seller held it for the full maturity, and then they deserve, right, the interest. But if the seller sold it to the bank on day one, they didn't take any risk. They are not taking, from the minute they are selling it to the bank, they are not taking any risk, right? And it's the bank that's going to take the risk, right? The seller isn't waiting at all, not taking any risk, but the burden of risk and waiting falls all upon the bank. Okay, makes sense? So a bank deserves the full interest. The seller deserves no interest, right? So this process, if you think about it, what risk are we talking about? think about it, the risk of the issuer defaulting, right? So if you think about it, promissory note is like a short-term loan, right? Short-term loan for 60 days, given by whom? Given by the seller to the buyer, right? In other words, when seller agreed to accept the promissory note, it's like, giving a 60-day loan to the buyer or the issuer of the promissory note. So in other words, the issuer of the promissory note is the borrower, right? It's like, they borrowed for 60 days, the money that they would pay back in 60 days, right? So think about it. The when you are lending, so the it's like, this seller has passively become a lender. So when you are lending money, what is your biggest concern? Your biggest concern is whether you'll get your money back, right? But also, you can rephrase it as whether the buyer or the issuer of the promissory note, whether the borrower will default on their loan, right? Makes sense? That is the biggest risk you are facing, right? So once the this company sells the promissory note to the bank, the risk is all transferred, right, to the bank. Makes sense? So the bank won't do this for free. The bank will discount. They will need to take their cut. So for doing this service, for taking the risk, instead of for the bank will have to take their cut for. They will need to get compensated for taking this risk for this seller. Make sense? So logically, it would make sense that the on day one, if they brought it on day one, right, to the bank, then the bank pays only the principal and keep, at maturity, they present it to the issuer and they receive 11K, and then they keep the entire, they make the entire interest. They keep it to themselves. Okay, makes sense? That process is called discounting. I mean, because the maturity value was 11K, but they discount it to 10K and just give 10K to the seller. Now, this process, it's called a simple discount, right? And interesting thing is, they, in this example, they just simply discounted it by the interest, right? But actually, so you might think, oh, so they took that 10%. Yes, but actually they may discount it by more than 10%. The bank may discount it by more than 10%. For example, they can discount it by 15%. If they discount it by 15%, right, and it will be, roughly like 85% of this that the company will be getting, right? But again, think about it. Bank is not a philanthropy. Bank is not charity or philanthropy. Bank is in a very selfish, business, right? Any business, all the businesses are operating for their own self-interest, right? So the bank will try to apply higher discount rate, right? Higher discount rate, as high as possible, right? As high discount rate as possible, right? To skew the skew that split more to their favor. You understand? So, and this process is, called, factoring. I'm going to get to that term later. Now, so there are two types of promissory notes. First, non-interest bearing and interest bearing. Of course, we've been using interest bearing promissory note examples so far because that is normal. But sometimes some promissory notes are non-interest bearing, meaning they're not paying any interest. And is it possible? I mean, yes, it's possible. Think of it this way. So once again, it has a lot to do with the balance of power, or the power dynamics between the seller and the buyer. Now, if the buyer is a large company that has strong influence in the industry, right? Usually, the stronger, strong companies, exercise a lot of influence in the industry. So in a way, they flex muscles, and smaller.
I guess I can skip this part because it's too much discussion about the intricacies of this, but we just want to get the mechanism of
suppliers.
simple.
They borrow. Are you going to say that to, right? Whether you like it or not, you'll have to. Okay, now, and when you receive this you'll take it on daily. When you take it to the bank will apply. So suppose you are holding on to it for the first 10 days. This is a 30-day promissory note, right? Non-interest paying 30-day promissory note. You were holding on to it for the first 10 days. Originally, you had no problem with cash flow, but suddenly on day 11, your company suddenly ran into a cash flow problem. You're tight, very you're out of any cash flow. So what do? Then you'll take it on day 11 and you sell it. You take it to the bank and sell it to the bank. Or in other words, it's also called you factor it on day 11, right? And then the bank will. What does that mean? Then the bank will, if the bank buys it from you, they are taking over the risk, right? And then they will hold it for 20 days and they will present it to the buyer. So they will have to discount it. So they will discount it for the period that they are holding it. In other words, they will discount it for 20 days because for first 10 days it's already gone, right? First 10 days you are holding on to it, so it's already gone. And then what's left is 20 days, so they will discount it for 20 days, right? Makes sense? So that means they will use, it's like, so if they use 10% discount rate, what is their cut? In other words, if they use 10% discount rate, what they will do is they will discount it by the interest they take is 10% of 10K. So, but it's for 60 days. So, I mean for 20 days. So actually to calculate it, it's going to look like so what I'm doing here is how much interest are they taking, right? Or how much it's not, I'm just calling it interest for now, but it's not really it's called the bank discount. So the calculation is simple. You will you will multiply 10K by sorry, that's not 10K, 10K times 10% times 20 over 360. Okay, makes sense. Now this is called actually a bank discount. So but although this is the exact number will be calculated this way, but let's just say this is 1K. Okay, just to make it simple. Okay, let's just say this is 1,000. Then what is exactly what amount are they paying you? Then they will be paying you, right, 9K. This is what you get, right? They will keep 1K. In other words, the promissory note with the face value, maturity value of 10K. Maturity value is exactly the principal in this case because there's no interest paid, right? Interest on the promissory note. So you take it to the bank, and bank used 10% discount rate. They are discounting it by 10%. And although it's for 20 days, you just ignore it. Let's suppose just so they are discounting it by 10%, which is 1K. Then what are you getting? They will give you 9K. Make sense? But for you, you might say, oh, that is, you might say that's unfair. You might say that's unfair. No, but it's better than nothing. I mean, if you don't, remember, you're in a cash flow problem, right? You're in a very dire cash flow situation, and if you don't have any cash, then you will go bankrupt, right? You have a lot of payments to make, and these payments must be made in cash, not anymore in promissory notes. Think about it. You have, because of these accounts payable and notes payable, you have a lot of accounts payable, a lot of notes payable. So you need cash of at least this amount, equal to this amount, right? But you don't have cash for this, then just because of that, basically you are defaulting. You're defaulting on your payment obligations. And if this piles up, that's bankruptcy, right? So the idea is, the bank discount. This is called bank discount. I'm going to have to what you receive from the bank is called proceeds, right? And the symbol for that is D. Okay, so this is the discounted amount from the maturity value, right? Discounted amount that you receive from the maturity value. And the bank is going to hold it for 20 days, and they present it to the issuer, and they will receive 1K. Okay, so this is called bank discount. In other words, that's the you can think of it this way. That's the upfront interest that the bank takes, right? That's the upfront interest that the bank takes from. So this is the bank discount. Okay, and then and the 9K that you taking from this bank is called proceeds, right? The correct terminology is proceeds, and the symbol for that is D. Okay, so never mind, proceeds is P, D, so you cannot make connection between P and D. Never mind. D stands for obviously discounted amount, right? Discounted amount of the promissory note. But that's what proceeds from this negotiation with the bank, this factoring with the bank. Okay, so that's the concept of simple discount. But in this example, this was very basic example. And
okay, so this video number 2, factoring part 2, still, we haven't got to the mechanism yet, but 3, we're gonna see the
you're looking at I hope you're looking at the same file as I'm looking at. We basically defined what non-interest bearing promissory note is. I mean, there are two types of promissory notes: non-interest bearing, meaning paying no interest, and interest bearing, paying interest, of course. Now, let's define a couple of symbols, right? First, B stands for bank discount, right? Bank discount, and FV here is actually what I called maturity value, right? FV is maturity value, actually. So maybe I can, but there's a reason why I left it as FV, because in case of interest-bearing promissory note, the maturity value is the future value, because it pays interest, right? If you borrowed $10,000 today at 10% interest rate, that means you issued promissory note. You issued a promissory note for $10,000 at 10% interest rate, right? So 1 year later, you will be you owe, right, $11,000, right? So that's the future value, right? As well as the maturity value, because at maturity, that's what you pay, right? That's what you owe. But with that in mind, now think about it. D is the discount rate, right? And T is time. So just like in our example last time, if it is non-interest bearing, this is wrong. In a non-interest bearing case of non-interest bearing note, I'm sorry, this one was, I don't know, I was probably just too tired and even didn't notice the arrow I made here.
okay, I'll skip that part.
But in case of interest, I am so sorry. Made, unaware that you are blurting out something that you're not clear. Oh, professor, you said this, but if you ask questions, in the discussion board, I will clear interest, isn't it right? This is only interest. So actually what I did here is finding the future value. In other words, future value is the maturity value. That's what I wanted to say. 1 plus R times T. Okay, that's I was all along I was saying payment method for the seller method or payment mode is the promissory note, and for the buyer it's vice versa. For the buyer, the least preferred mode is the it's like racing ahead your body. Your mind is steps ahead and your mouth is so at this time we are back we are now defining the symbols in the non-interest bearing promissory note. So so B is basically it's called bank discount. Bank discount is like the when the bank is buying this promissory note, this is what they take for their own cut. So this is like the interest that the bank takes, right, up front. Why? Because they will pay you money. They will give you the, as I said, if your client gave you $10,000 promissory note with 60 days maturity, right, and if you hold on to it for 60 days, you present it to the issuer and receive $10,000. So there's no interest. Nobody will be happy to receive zero interest paying, non-interest paying promissory note that will mature in 60 days. And if your company isn't going through a cash flow shortage situation, then this won't be a problem. But since this is a problem if your company is going through cash flow shortage, so you take it to the bank, and the bank will pay you something, but they're not going to pay you $10,000. That's the idea behind this, right? I'm repeating this over and over every lecture about something like 9, 10. So they took 1K from this time. I mean, if it is for 60 days, right? So that's 10K times 10% times 60 over 360, right? So this is, in a way, if you think about it, there's a parallel between interest and bank discount, because interest is P times R times T, P times R times T. Now think about this. In case of promissory note, zero coupon or zero interest bearing, non-interest paying promissory note, this is exactly P, isn't that right? This is exactly P. So the only difference is that in this case, this interest is added to the principal, right? This interest is added to the principal, right? And then that's the future value. But in simple discount is also called bank discount. And in case of simple discount, the mouse's mind of its own. And think about it. If this is what the bank takes, what is left for you is P minus B, isn't that right? It's P minus B. So that's called the proceeds. Okay, that's called. Did I write proceeds somewhere? I don't see proceeds. Okay, so P is, D is called proceeds. So this is what you receive from the bank. Okay, D is this, lowercase d is the discount rate, uppercase D is proceeds. Now, so if you rewrite D by definition, right? D is the first of all, if I this FV, which is also maturity value, but in this case, because it is not paying any interest, maturity value is the same thing as the principal, right? And then B is by definition what? P times dt, right? P times dt. So you factor out the common factor, it becomes P times 1 minus dt. Or what is, if it is interest paying promissory note, what is this? It's MV, right? Or future value, right? Maturity value times 1 minus dt, okay? Now, please, make it very clear in your mind that FV and MV are the same thing, right? Maturity value is the future value. But think about it. When, if the note pays any interest, then maturity value is the future value. But if the note doesn't pay any interest, then the maturity value is exactly the principal, right? So now, with that in mind, let's go to this example. Okay, let's go to this example. So first, $200 is the principal. 5% is the discount rate. Time is 2 years. So then what is the proceeds? The proceeds are then, P times 1 minus E times T. Okay, and there you go. So what does this mean? This is what you receive from the bank, right? This is the proceeds from the sale of the note, non-interest paying note. And what is the bank discount? In other words, what's the bank's cut? What does the bank take? It's the difference between the two in this case, right? Makes sense. Of course, we can calculate B first, right? Now, here, the process is perfect. I mean, what we are doing is, perfectly, correct. But there is something I have a problem with. What is the problem? This time. Why? Time is 2 years, right? But then you understand everything is, short term as far as we are using simple interest rate, right? As long as we use simple interest rate and using simple discount, this is just hypothetical. This is just an example for exercise, right? For practice. So in reality, you won't see maturity like this. And then, well, I already converted everything into years, but second problem, 5,000, principal is 5,000, discount rate 8%, time 90 days. So we converted into we converted into years, right? And ordinary always, unless otherwise specified, right? Ordinary is the default, right? So what is the proceeds and the bank discount? Now we don't have to do it again. We do it exactly like first row, I mean row 12. So you can just copy and drag it down. There you go. And then you say, oh, can I copy and drag it down? No. Why not? Because row 14, what is the primary solution cell? The primary solution cell is, the main solution cell is this, not this, right? So you remember that all yellow highlights mean primary solution cell. So here, this one, all you need to do is, then we know what to do. This is just simply principal times D, discount rate, times T. Okay, and then the D is proceeds is the difference between the two, right? There you go. Now this one, okay, this is finding principal, right? This is the solution cell. So, and here, same 270 days, but when you convert it into year, it's different. So what does that mean? That means for this one, it's it's exact interest here. So then our next question. So how do we solve for principal? You remember what we did with interest? Remember that? So I guess I'll have to use this space. So when you, with that, if P is the unknown, what is that? I over R times T. And if R is the unknown, what do? I over P times T, and so on, right? Also, if T is the unknown, right? You know how to do that. So apply, it's the same logic because B is P times or MV times dt, right? Let me erase this. I should have put it there. So if that's the case, right? If that's the case, P is, because think about it, starting from, I'll have to use this space. Starting from in your mind, you should be flexible enough to replace this with P, right? Or FV, right? So if that's the case, then P or the maturity value, in this case, maturity value is the exactly P, right? Or P, right, in this case. What do? Then you do B over, right, D times T, right? And think about it. Also, if D is the unknown, D equals B over P times T. It's all. So here we. So then what? Then there's one more question, right? We need to use B, but we don't know what B is. This is a problem. But also, we can find this because another formula is what? If D is, right? So D is, what? D equals mv over 1 minus dt, right? So what do you need to do? It's simple, right? So also, maturity value OP, I'll do that later. I'll take care of it. As D over 1 minus dt. Okay, so this is how you find principal or maturity value, right? When you know B, this is how you find it when you know D. So this is very basic math, basic algebra, not a big deal. All right, so what is the principal? D over, right? 1 minus D times T, okay? And then what about this? You cannot just drag it down because the input variables are different, right? So here in this case, the principal is B divided by E times T. I guess in this example, they used ordinary interest year because 180 days or 180 days to be exactly half year, right? 1 year has to be then 360, not 365. Anyway, you get that? Well, there you go. And by also, you can, something like this, it may not be easy to mentally check, but something like this, when the numbers are, when all the input variables are round numbers, you can easily check mentally, right? What that means is, look, if it is $20,000 and 10% is the interest rate, right, or discount rate, for the whole year, what should be the bank discount? For the whole year, it would have to be 10% of this, which is 10% of this, which is then 2,000, right? But it is only half year, so the bank discount or interest has to be half of that, 1,000. This already, just conforms to a common sense, right? It doesn't take, very sophisticated procedure. Just mental. This is very, basic critical thinking, and also, deductive reasoning. So you are making a, you can, check and confirm, verify, very easily. Now, next, we are going to discounting interest-bearing notes, but before we go to that, let me, I guess, it will take some time to do this. I mean, it's just an extension of this, so it's not that difficult, but we don't have enough time for that, so it will have to be the next video. But before we go, let me explain. There are two types of factoring. One is factoring with recourse. The other one is factoring without recourse. Recourse means you have something to fall back on, right? Some support. Factoring without recourse, there's no support. So what does that mean? Factoring with recourse is the seller, in other words, the one who brings the promissory note to the bank. Seller pays the bank if the issuer of the promissory note does not pay. Well, normally this won't happen that very often. Why? It's mostly factoring without recourse. Why? Seller does not pay the bank if the customer, the note issuer does not pay, right? So think about it. What kind of issuer would default? They would be the ones with very, very, very low credit rating, derogatory credit rating. So if the company with, if I'm dealing with a client that has very bad credit rating, I'm not going to accept their promissory note, right? And if the only way they can make me, accept the promissory note is only if they pay very high interest, right? enough to cover for that risk. But then, if I take it to the bank also knows that this is a very iffy company, right? Very iffy, very highly default probable company. So the bank is not likely to accept it either. The only way the bank is going to accept it is by discounting it also very, very deeply, right? Discounting it very, very deeply. They also need to cover for their risk, right? So usually it is factoring without recourse, but if they don't discount it deeply, and if the note issuer defaults, then where do they collect the money from? And they will have to come to you to collect the money, right? So that's factoring with recourse. Okay, so that's it for this video. I will see you. I will sign off and see you guys in the next one.
All right. It was a very long, extended coverage of factoring, and I don't. Since I was skipping, I was skipping, from time to time. I don't remember if the naming, why it is called, it's basically a simple discount, but where did the word factoring come from? I don't know if it was discussed in these 3 videos yet. If it hasn't been discussed yet, it will be discussed in part 4 and 5. But this is all the time we have for today. I mean, we can. We have only about 7 minutes, right? So we cannot start viewing video number 4 and 5. So we're gonna do this next Monday. Okay, we're gonna. But so far, any questions? Any questions so far? Any questions? Shanaz, you had a question during the break. Do you still have the question? If you do, now is the time. Shanaz? All right, very quiet. All right, it looks like I'll take it as no. It looks like nobody has a question. So I guess it's right time to call it a night. So have a great evening, everyone. And don't forget, today's the 27th, so the first test is due tonight, and the second one will start tomorrow and will be due on Sunday. Okay? So please don't forget. All right, have a great evening, everyone, and have a great weekend. And I will see you guys next Monday. All right? Anyone?
Take care.
Good night, Professor. Thank you.
All right, take care, Jasmine. Take care, Nikisha, and I will see you guys next week. All right, stop recording.